I'm into ancient texts, manuscripts and papyrus fragments. Epigraphy less so, but at least it looks cool. It has an aesthetic appeal, unlike these crappy little scratched stones. But these stones, inscribed boundary markers, or horoi as they're called, are more interesting than they might seem. The network of horoi across Attica could be likened to a proto-de facto security or mortgages register. I discussed the horoi in a video I did on secured lending a few years ago, but I thought it would be apt to revisit them today because they tie in with a book that's out this coming week. But we'll come to that at the end of this video. Meantime, welcome to Ancient Classics. Back in the pre-classical era, land ownership across the countryside of Attica was vested in the hands of landowning families, it seems. According to some scholars' views, land belonged to a family and could not be transferred to non-family members, at least not in archaic pre-classical times, though this view is disputed. Either which way, it seems that by the 4th century, land was transferable, at least as between Athenian citizens. Now, if land can be transferred to a non-family member, it follows that an indebted landowner can transfer land to a creditor, someone to whom he owes money, possibly in lieu of payment of the debt. Or to take it a stage further, it follows that a creditor can take possession of a debtor's land, sell it, and pay off the debt owed to him from the proceeds. In other words, where land is transferable, as it was in 4th century Athens, a debtor can grant security over land, i.e. grant a mortgage. All well and good. A lender is much more likely to lend and to lend on favourable terms, where they can take security. That's a commonplace of finance, one so obvious that it barely merits comment. It's why banks will lend hundreds of thousands of pounds to a retail borrower to finance the acquisition of a house, subject to a mortgage interest, but would never allow the same borrower to run up a credit card debt of that amount. And much the same principles apply in the corporate lending world. But it's not enough for a lender to simply have the legal right to take and enforce security. All other things being equal, there's nothing to stop a debtor from granting security rights to other lenders, run up massive debts, and leave the lenders fighting over who has the right to the secured property and the proceeds of sale. This is where the significance of a land register or mortgages register, the two are usually combined, comes into play. If there exists a register open to public inspection, then any putative lender can check whether a property is subject to a prior existing security right, and moreover, by registering their own security interests over a property, one lender can ward off other potential lenders. But back to ancient Greece. Remember those horoi I mentioned, the boundary stones? By the mid-4th century, if not before, it became common practice for such horoi to be inscribed with the names of secured lenders, i.e. those who had loaned money to the landowner and had a legal right to take that property and sell it if the landowner refused to pay its debts. Dozens, perhaps hundreds, I don't have the precise figures, of these inscribed horoi have been found across Attica. Many of them use the same or similar formulaic language. Here's a representative example, taken from Fine's 1951 paper, Horoi, Studies in Mortgage, Real Security, and Land Tenure in Ancient Athens. This translates loosely as boundary of a house, a shop, and a garden having been sold for redemption to Kalipos of Phaleron. So, this one seems to be from an urban building rather than a rural boundary marker, but hey, the principle's the same. The term having been sold for redemption, pepramenon epilusse, is a technical legal term, perhaps indicative of a title transfer arrangement, where property is notionally transferred to the lender, subject to a right of retransfer in case the borrower repays, which is actually how a lot of security-type arrangements function in the modern era. But let's not get too hung up over the technicalities here. The key point is this: it makes clear to anyone passing by, contemplating perhaps whether to lend money to whoever owns and occupies the building, that this guy, Kalipos, has some kind of security interest thereover. When you take into account the fact that there would have been a whole network of these kind of markers across Athens and Attica, you have what is, in effect, a de facto real estate security register operational by the 4th century BCE, and quite possibly before that too, writ across the physical land and cityscape of Attica, and quite possibly supplemented by centralized manuscript registers, which have since been lost. And sure enough, our literary sources, specifically the speeches of Demosthenes and the like, are replete with references to loans secured on real estate and other asset classes too. There even seems to have been a technical legal or banking term distinguishing loans secured on real estate from other types of loans, and they seem to have carried more favorable interest rates, so much so that the phrase ἐγγείος tόκος, real estate interest rate, was a technical term for the more favorable interest rates that a mortgage loan would carry. Tokos literally means offspring, i.e. interest in a finance context. Ἐγγείος is an adjective meaning to do with real estate, to do with the land, cognate with Gaia, the Earth Mother, I guess. So you could say that the literal meaning is offspring of the Earth Mother, but I'm just being cheesy here. To ground this in a particular text with which I'm familiar with, and I'm sure there are others, let's look at Demosthenes 34, in which the speaker refers to how his opponent Phormeion allegedly paid off a high-interest maritime finance debt with funds raised at a lower real estate interest rate, ἐγγείος tokos. This gentleman had lent Phormeion 2,000 drachmae for the two-way sea voyage on terms that he should receive at Athens 2,600 drachmae, i.e. 30% interest over the life of the loan. But Phormeion claims that he paid Lampis in Bosporus 120 Kyzikene statas, make sure to bear this in mind, which he borrowed at the interest paid on loans secured by real estate, ἐγγείον tokon. Now, interest on real security, ἐγγείoi tokoi, was 16 2/3%, and the Kyzikene stata was worth 28 Attic drachmae. Well, so what? Recall what I said earlier about the existence of a functional mortgage or security register as being essential to the functioning of our modern economy and society. Well, that's not just a facile truism or piece of trivia, it's a fundamental and well-established economic principle. In his paper, The Legal Foundations of Economic Growth in Ancient Greece, The Role of Property Records, Edward Harris cites the economist Hernando de Soto, paraphrasing him thus: according to de Soto, the establishment of a formal property system brings with it 6 major advantages. First, it fixes the economic potential of assets. What was formerly viewed as a place to live or to grow crops becomes something which can produce value, either as collateral for a loan or as equity that can be exchanged. Second, property records integrate dispersed information into one system. Third, property records make people accountable. Fourth, property records make assets fungible. Fifth, property records help to network people. Sixth, property records protect transactions. Now, the horoi were just a first step, or perhaps an ancillary aspect in a land and security registration system. But their stone-hewn physicality means that they have survived for us to see today, unlike any centralized documentary records, all of which would have been lost, but are alluded to or hypothesized in many of our sources. Harris concludes his paper with the observation, the role of the state in protecting property rights and creating archives with documents to prove ownership helped to lay the foundations for economic growth in the world of the Greek polis. By promoting security of title, they made it easier for borrowers to obtain credit. Although the information contained in these records is inadequate by modern standards, they were sufficient to expand the circulation of assets outside of a restricted circle of neighbors and family. This was one of the prerequisites for increased specialization of labor, the development of markets, and economic growth. Now, I'm a banking lawyer by trade, and so I have a professional interest in the creation of security and its registration. Some of my earliest tasks as a trainee lawyer in the noughties involved popping down to the London branch of Companies House to register security interests created by companies, i.e. in my 20s, I was doing the modern-day equivalent of some scribe or stonemason chipping a secured lender's name out on a horoi somewhere in Attica in the 4th century. But these days, I focus primarily on bank regulation, regulatory capital. Regulatory capital is, simply put, a system of rules requiring banks to issue and maintain capital resources, equity capital and subordinated debt, the quantum of which is a direct reflection of the bank's credit exposures from time to time. Banks are always looking to minimize their capital requirements, and one of the key ways in which they do this is by entering into security arrangements, thus mitigating the credit risk represented by the loans they make to the borrower in just the same way as the ancient lenders did, and therefore reducing their capital requirements. Now, There are dozens of law books out there focusing on how banks can create, register, and enforce security arrangements, and the fundamentals are really not too different from what we can see going on in ancient Athens. But none of the law books published thus far properly deal with how those ancient legal techniques interact with the modern bank regulatory capital regime, which is crazy because, believe me, it's what banks are most focused on these days. So there's definitely been a gap in the legal literature until now, because I've co-written the legal text on this subject, one every modern banking lawyer needs. It's called Credit Risk Mitigation and Synthetic Securitization, Law and Regulation by Timothy Cleary and yours truly. It's out this coming Thursday, 22nd of May, on Oxford University Press. If you work in law or finance, I'd highly recommend you put in an order for your team library. Link in the description. But to be clear, I wouldn't want to missell anything, and our book's all about modern banking law, not classics. Though I couldn't resist dropping a reference to our ancient pals and Professor Harris. I mean, how could I not? So I'll wrap things up with a arrogant first, my very first self-quotation on this channel, taken from Chapter 6, Real Estate Finance and Specialized Lending, of Cleary and Morris on credit risk mitigation and synthetic securitization. Security over real estate is not quite the oldest form of security, but it is perhaps the most important and has been so for millennia. For example, Edward Harris notes that land reform and the development of a de facto land registration system in archaic Attica allowed for the grant of effective security interests over real estate, encouraging financial and commercial innovations and contributing to the birth of Athens' classical golden age. I love finding random connections between the ancient Athenians and modern finance. Have you come across any other ancient Athenian finance parallels in modern banking law? If so, let us know about it in the comments. I also feel that the Romans get far too much credit here. And side note, why do they teach Roman law on law courses, not on classics courses? I did a classics undergrad, not law, so ironically, I'm more intimidated by Roman law than most, which is why you won't catch me speaking about Roman law on this channel. But hey, meantime, like and subscribe, and we'll be back soon.